Welcome to Holistic Accountant Podcast, where we aim to showcase how adopting a holistic approach in accounting and tax maximizes value for clients. Beyond traditional tasks like preparing financial statements and tax returns, a holistic accountant focuses on offering advice that maximizes personal wealth on an after-tax basis. If you enjoy this episode, please consider leaving a rating and sharing it with those who might also benefit. And to ensure you stay updated, subscribe to our weekly email. The link is in the show notes. Okay, Mena and I would like to talk today about raising capital for your business. Now, you might want to do that for two ways. It might be an external investor that you would like them to contribute funds into your business to help grow it. Or alternatively, it might be about retaining or attracting great people to sort of work in your business. So let's talk about the first one, which is, let's assume that you've got a team member that either currently works in your business or you'd like to attract to your business, and you want them to own a share of that business. And there's a couple of different ways to kind of structure that to make sure that person's well rewarded, but also make sure they've got some skin in the game as well. And of course, the most obvious is just straight equity. That is that you issue shares or sell pre-existing shares to them in your business, whether it's units in a unit trust or shares in a company, and they buy those shares for a certain value. Now, of course, you have to have the business valued, and depending on the stage of the business, the industry and so forth, that can be either very straightforward or very complex. But that's going to be your main stumbling hurdle, or is making sure that, or allowing the person to make a judgment on the value of that equity that's been issued to them. And of course, if you want to attract the right people, you really want to make that value as attractive as possible. So not give away the farm, but also the goal isn't to maximize the consideration. It's really to hopefully lock that person into delivering a lot of value in your business.
And I might just add on that sort of fixed price equity sort of model, you got to be very careful in that you don't sell yourself short, because if your business is at its infancy stage and you got a lot of upside, for example, that valuation would obviously come in a lot lower than what you'd expect it to be because your business isn't performing as well. So fixed price equity isn't always the solution. The next one which could provide more of a sort of unique and dynamic solution is what is called convertible notes. So that basically represents an agreement between yourself as the business and the staff member or the investor as such. And they can either choose to, or either party can really choose their interest in either repayment of the loan or get shares back in the company. You can set certain conversion events in place for that staff member to meet. So, for example, it might be a key performance indicator that they must sort of drive sales by 100,000 within a 6-month period, or be that they need to win another 100 clients over the next 12-month period. Any other sort of KPIs that you put in place to allow you to give you sort of that security that this person has skin in the game and your interests are aligned and that you're willing to give them equity.
Another consideration is that if you're trying to attract someone into your business, they might not necessarily have the financial standing to go and lump up a whole bunch of cash, but you still might want them involved in the business. But at the same time, you don't want to give it away for free, of course. So another way to structure it would be to use vendor financing, which essentially means that I'll let you buy these shares in my company, but I'm going to lend you the money to fund that purchase. Anyone that's involved in lending would know that it's really important that the borrower has skin in the game, something to lose. And so in that situation, there's less for that person to lose, and we only value stuff that we actually have to pay for. So it could be that you don't vendor finance the 100%, maybe 50% or something like that. So at least they've got some cash at risk. And even if you don't go that far, the alternate would be to require them to direct all dividends towards the loan repayment, which I've seen work really well in lots of situations. So that means that you might lend them 100%, but they'll be entitled to some dividend income, but that dividend income goes directly to repaying that loan that was used to purchase those shares. So really, they're not going to then share in any income or profit distributions until they've fully repaid that loan.
So what kind of interest rates would you expect in these types of arrangements, Stu?
Look, you'd normally charge a margin over the bank bill swap rate. What that margin is going to depend on how attractive you want to make it to invest in the company, but I think somewhere between 2 and 4% above the bank bill swap rate would be what I would regard as a relatively commercial margin. So what about if you want to attract an external party? So that is a non-working investor. Really, either you might want to attract them just purely for their capital, or maybe also for their expertise if you think that they can add some value in your business, either strategically or maybe they've got industry contacts and so forth. Well, the first thing that you want to consider, and really what you need to do, is put yourself in their shoes. The first thing someone's going to think about when investing in an unlisted business is, how are they going to get their money back? Is the plan to sell the business through a trade sale or listing or something like that? In which case, then maybe there is a clear exit strategy. In most situations, that's not going to be the case. So then structuring the equity contribution as a loan instead of purely just as equity might actually feel quite attractive to that investor, because they can see, well, firstly, they're going to get interest payments. So they're not relying on the profitability of the business to get a dividend. So at least they're going to get some initial return. Secondly, they'll get their principal back at some point. And then what you can do is add equity in as like a loan application fee. So, for example, if I wanted to rack $500,000 investment into the business, I might structure that as a loan. So I say, okay, you put $500,000 in, I'll pay you an interest, and maybe there's a principal repayment schedule. And then in return for you providing me that loan, I will also give you 10% of equity in my business. And in that situation, the investor's going to feel like, okay, I've minimized my risk. I've got some interest, and then once the loan's repaid, I'm still going to have some equity exposure to this business, which is going to, reward me for whatever, firstly, lending the capital, and then secondly, if I'm able to help that business longer term. So, Mena, if someone's in that situation where they're looking to attract capital contribution to their business, how do they go about doing that, and what's the right option in terms of structure?
If you're a business that's basically been trading for a long time and there's not plenty of upside, and you basically just want to retain talent, a fixed price equity model is probably going to be the most simplest and easiest way to value your business and attract the right people to your business. However, if your business is, for example, in its infancy stage and you're trying to get ASX listed or get some large funding, then obviously you're going to go out to the general public or a wholesale investor, for example, to fund that expansion. Then convertible notes is something that safeguards their interest as well as your interest.
Okay, there's plenty to think about when raising capital, attracting investors to your business. They're just some of the matters. It's a very complex area, not only from a taxation perspective, but even from a business strategy perspective. So certainly something that your holistic accountant can help you with. Okay, that's it for this week. Until next week, bye for now.